Hey everyone, welcome in to another daily editorial here on the KE Report. Chatting with Jordan Roy-Byrne, we're going to get some updates on what he's seeing in the charts for precious metals as well as some of the ETFs that follow those precious metals stocks. Jordan is the founder and editor of the Daily Gold, which I will link to below. Now, Jordan, first comment, something that we talked about, I believe it was last week, is how gold was doing against the 60-40 portfolio. Now, this is a metric that I believe you have developed internally, looking at, again, the gold price versus that whole portfolio of 60% stocks, 40% bonds. You were noting last week as we approach the end of the month that it could close the month in a very bullish way. How did we close the month? Give us an update here.
Not great, actually. I'm trying to pull up the chart, but I do it by monthly data because it's difficult enough to get data going back decades. So monthly data is what was available. So I had someone calculate the total return on bonds, and then I found some total return data for stocks. So it's almost like we're looking at gold divided by 60% SPY and 40% TLT. So that's kind of roughly how it looks. But historically, there were clear points where gold against this ratio, whether it was a breakout or it moved above a certain level, like when that happened, you could say, okay, it's clear there's like a new secular trend here. And the secular confirmation occurred historically. You had it in 1972 and then also 2002. And we're really close to getting it now. But the way gold closed the month, gold sold off, and I think the stock market strengthened a little bit. So a week or so ago, it was looking like gold against the 60-40. It was like would have closed at a new 3-year high, I think. And then at that point, you could say, well, this is like we're really starting to see that confirmation of a new secular bull. Unfortunately, again, this is based on monthly data. It did not maintain those gains, and so it closed below by a couple percent the resistance, that it needed to surpass. So that's just it. It's I don't want to say it's a minor thing, but yes, gold looks good nominally. It's acting pretty well in real terms, but we did not get the secular confirmation this past month. And so, maybe precious metals will continue to correct here for a couple more weeks for this month. And, maybe it'll take 2 or 3 more months and a gold move to, 24, 25, 26 to make a move in this ratio, or to put the ratio in position where it says, okay, it's clear we're in a new secular bull market for gold, or we have confirmation at least. Because again, historically, those confirmations came like a year or so after the gold market bottomed.
So, Jordan, what about simply gold against the stock market then? Because the stock market started to show weakness at the start of, well, last month. And now that we're in May, it started to show weakness at the beginning of April, but it was bought back a little bit at the tail end of the month. And overall, we have heard from some commentators that as well as gold has done, well, so have the markets. What do you see the balance being here?
Yeah, well, obviously, again, this is 60% of the gold against the 60-40 calculation. And you look at the gold to S&P 500 ratio, that has resistance right around 0.50. After yesterday, the ratio closed at 0.46. So 0.50, so that's call it 9%. We need to see a 9 or 10% move in gold relative to the stock market. That would be a clear breakout in the ratio. Like that would put it at a new 3.5-year high or so, and that would be significant. So yeah, so gold is still, it hasn't broken free relative to the stock market, although it has had a really good move in the last couple of months from 0.40 up to, it looks like, nearly 0.49. Now it's come back a little bit to 0.46. So there's still some ways to go to get that breakout there. And the same goes for the gold against the 60-40. And this is significant because when you see gold clearly breaking out against the stock market and the 60-40, that is a signal that capital is moving out of those areas and into gold. I mean, we've already seen a lot of capital move out of bonds, but we haven't seen capital really move out of stocks yet and go into gold. But when that happens, that's really going to turbocharge this new bull market in precious metals. And so, maybe that, when the economy rolls over and the stock market cracks, and the Fed is forced to cut, you'll probably, I mean, that probably, the market will discount that in advance. So when you see gold making that big move in real terms, like that's probably what it's going to be leading or signaling.
Yeah, that could be a huge move for the gold market, but again, it seems like we've been waiting for that for quite a while here. However, as you said, money has rotated out of bonds. Look at how much higher interest rates are right now. Let's look simply at the gold price. Now, we are talking right after the Fed meeting. Gold's getting a bounce. Pretty much everything's getting a bounce outside of the dollar. But gold went right back down to about that 2,300 level off of its highs from kind of late April. But overall, again, that's still a very strong gold price. What are you watching for in terms of this correction where gold was overbought, especially on a daily basis? It's still above a number of moving averages. What are you watching for the gold price in terms of this current correction?
I'm watching the gap down to, I think it looks like it's at about 2240 or so. There's a couple open gaps down to, again, 2240 or 35. That looks to be the lowest point. That would be about a 9% or a little bit less than that correction in gold. You look at the 50-day moving average, that's at 2228. So that, I mean, this thing is screaming higher. So you could see a little bit more selling in gold where it comes down and fills that gap and then bounces around the 50-day moving average. Those are support levels that I'm looking at because, again, historically, when we look at gold breakouts and we look at the gold having really strong momentum, in those scenarios, it tends to correct down to around the 50-day moving average, and then the move continues. So that's one scenario I'm looking at. I have been looking at for the last couple of weeks. However, we should also keep in mind, gold's had 7, I think, breakouts historically. 2 or 3 of those breakouts, it came back all the way and actually retested the breakout. So it is possible. That's the other scenario where gold could come back and retest 2100, or maybe it comes back to 2150. So that is the other possibility. So either way, gold is still in really good technical shape, but either way, I think there's more correction in price and time.
Yeah, that's a key too. Price and time. Let's also look at the gold mining ETFs, GDX and GDXJ. Both have pulled back to test some new support levels. That's about 32 in GDX and about 40 in GDXJ. One other thing that you have noted too that we talked recently is some of the moving averages. On the daily chart, these moving averages are starting to tip up. On the weekly chart, though, a lot of these moving averages still relatively flatlining, but at least price is above them. What are you watching in these charts? What matters to confirm that this will just be a consolidation and potentially another leg higher for GDX and GDXJ?
Good question. One thing I'm watching is that the miners continue to perform well against the metals. It's something last week that I noticed. Of course, we're going through this correction in the metals, but last week the metals were down quite a bit, but the miners are actually slightly higher. So they've been showing really good relative strength against the metals, and I'm hoping, or at least looking for that to continue. I mean, looking at all GDX, GDXJ, SILG, all these ETFs, the action has been textbook where a month or so ago they broke above what was some resistance. They kept moving higher. Then they've corrected a little bit with the metals. They've retested that previous resistance. They back tested it successfully twice. But what does that mean now if there's more correction in the metals? Well, you're probably going to see the miners in that scenario go sideways. Maybe they'll test support again. I'm looking at GDXJ, for example, pretty good support at 40. So if it, I'd like to see it test 40 again, just because. Let me step back for a second. The miners, the price action is generally bullish, but more time here is required before they can begin that next leg up. They got so overbought. They're so far above even short-term moving averages that time is required at that point for the market to come back to an equilibrium. I mean, in that scenario, it can correct and consolidate bullishly, for another, I mean, it can go on for another month, or at least another week or two. So the setup in the miners, I really like it. It's bullish. Continue to watch and see if they hold up against the metals. And you just have to be patient and let things come back to an equilibrium. I mean, one point on breadth is if you look at just historically and some of these little corrections, you will see like the percentage of miners, GDX or GDXJ or Huey that are above the 20-day and the 50-day moving average. Like you need to see those come down more, especially the readings above the 50-day moving average. Like when those readings are above 90, I mean, you need to see those come down some more when you're in a correction, like before the next leg is going to begin. So that's something I've been watching for in recent days to see if we are going to see more of these stocks just correct a bit more in terms of the moving averages. And and so again, that's actually that's a good thing because you're getting closer to that equilibrium.
So carrying that over to GDX and GDXJ, then it sounds like time is kind of the key consideration. But what if GDX or GDXJ does temporarily break support, or when they even go down and test these moving averages over time, what if those moving averages are broken? Could these be false breakdowns and buying opportunities?
Yeah, probably. We will have to evaluate other conditions. I mean, you can never just go off of one indicator. But to give you an example, I'm looking at GDXJ, and of course, we have the Fed day, and the market likes whatever was said or it's reacting positively. GDXJ is almost up to 42. Like if you look at the 50-day moving average, that's at 38.02. I mean, that's a good 7-8% above the 50-day moving average. Whereas, the 200-day is at 35.62. I don't think the GDXJ has to test the 200-day, but I do think it's probably going to test the 50-day here at some point. Now that is sloping higher aggressively, so it's going to catch up to GDXJ in the next week or two. But again, here and now, it's like GDXJ is like 7 or 8% above the 50-day moving average, and it's still correcting. So I mean that tells you that more time is needed to get to that equilibrium because the 50-day, I mean that's you're that far above it. You're still pretty overbought in a very short-term sense.
So, Jordan, what is your trading strategy within your portfolio? I know you don't like sharing individual stocks, those are safe for your subscribers, but broadly, as we are in this time where you're looking for more of a correction, hopefully that correction is more in terms of time rather than significant price. Do you, as a trader, potentially lighten up on some positions here? Or if you have cash on the sidelines, do you wait to see maybe some outsized moves potentially in some of the stocks and use those as buying opportunities?
Yeah, I think it's stock specific. I mean, I'm not a trader, but I can talk about trading strategy as you ask. I think make everything stock specific because there can be stocks that are really good values that now is the time to buy those versus there can be other stocks where this thing's had a really good move and it has the rhino horn in the chart and it's really overbought. You don't want to be adding to that. But if there's something you think it is really good value and you look at the chart and you think, okay, well, this, there's a risk. There's not much downside risk, but there's also a risk that this could pop sooner rather than later. Like those are the stocks you want to be buying. Like you want to make it stock specific. And at the same time, you also want to go over all of your stocks and the ones that are really lagging, you want to think about dumping those potentially, or at least trimming those or cutting back. Like if you're over invested, you don't have that much cash. That's one way you can raise a little bit of cash. Actually, there's two ways. At the same time, you can look at the things that have done really, really well. Maybe they're really overbought. Maybe you just sell a tiny bit of those. You can build cash, and then you look at your laggards. Maybe sell a tiny bit of those, and that can help you manage your portfolio and give you more cash to, buy in case, maybe the sector corrects a little bit more than I'm thinking here. So it's got to be stock specific and just use common sense.
Okay. Hey, sometimes common sense can be hard in this market where we want everything going higher, and the market still is very much the haves and the have-nots, but we have gotten a decent rebound in a number of stocks. Some of those stocks are starting to give back those gains, though. So, again, I think this month is going to be quite interesting to see just how much more some of these stocks come back and what GDX, GDXJ, and even gold and silver do at some of these key points where they have just set up new support zones, seeing if they're going to hold those. Jordan, as always, great chatting with you. Thanks for taking time with me today. We'll chat next week. Again, to go check out Jordan's website, click on the link below to lead you to the Daily Gold. Have a great rest of your week there, Jordan.